and welcome to The Trade. Before we get into the technicals, let's have a quick look at what traders are watching, with the US economy seeing stronger than expected jobs growth in that delayed September non-farm payrolls data. However, the unemployment rate rose. Non-farm payrolls up 119,000 in September after a decline of 4,000 in August. The unemployment rate rose to 4.4% from 4.3% in August. Job gains in September partially flattered by difficulties adjusting for workers leaving their summer jobs, resulting in higher payroll counts in the leisure and hospitality industries as well as retail. The US 10-year at 4.1% and the US dollar a little mixed against the majors this morning. In fact, most weaker against most of them apart from what we're seeing with the Japanese yen. All right, of course, it's been a roller coaster session for markets. Let's talk us through now with Ilya Spivak from Tastylive. Ilya, what happened? Because, Nvidia sort of allayed a lot of those fears that we had, and then 24 hours later, we're back to being concerned again.
Very good to be with you, Juliet. And that's right. This was just the latest in this episode that's been playing out really since October the 29th. If we recall, and we just talked about it last week here, there was this moment where the markets started that last week of October seemingly priced for perfection. The big tech earnings were coming in and the expectations looked good. We just had essentially a pre-announcement of a cooling off of tensions between the U.S. and China that ultimately the two presidents made official. We had a setting of the board that looked generally positive, and of course the markets had a 90+ percent likelihood that a December rate cut would follow one in October. And then the Fed pulled the rug and said that that cut isn't coming. We've been relentlessly going down ever since. We've shrugged off all the positive tech earnings. We shrugged off the reopening of the U.S. government after the shutdown last week. There was a good 48 hours of upside momentum in that, and that was it. Nvidia didn't even last for 24 hours. And so what we are getting here is this constant display of the markets shrugging off good news and embracing bad news. Well, that's what happens in bear markets. In bull markets, you embrace good news and shrug off bad news. We saw that in spades from the lows in early April until these October highs. We have seemingly switched sentiment modes here.
Indeed. All right. Well, of course, a lot of that playing out in the bond market as well. And I mentioned those thoughts of what's going to happen with interest rates when we saw that September jobs report. What are we seeing on the longer dated front?
One of the most interesting things here about what's going on with rates is, of course, we've done nothing but talk about we need these rate cuts, more rate cuts. Only since this October move, really, have we seen the Fed kind of push back on that. Until then, it was all about we're going to get these rate cuts. And what we end up seeing here is, of course, from the lows in early April, bonds have steadily climbed higher. And this most recent episode, this is a weekly chart here that we're looking at, just the past 4 weeks or so since that late October peak, we've had a little bit of a pullback, but bonds are holding at the long end. And that seems to suggest, first of all, that risk aversion is flattering the long end as a safe haven destination, but also that perhaps the markets are starting to push more rate cuts further down along the time scale. And so it looks like, of all things, this is showing resilience when one might expect it to be more hampered. And that's probably a sign that this trend is likely to continue, and we could see the bonds continue to build higher, whether it's for risk aversion or future rate cut reasons.
All right, a bit of mixed movement in the currency market, but the euro looking like it's gaining some traction.
Absolutely. So late last week, there was this attempt by the U.S. dollar to come back a little bit. So we can see here that really since mid-September, the dollar has been tracking higher and in this very steady, unrelenting move. And that, of course, is very interesting because, of course, the peak in the euro here, right around the 119 figure, is where the Fed starts cutting. So that the dollar strengthens through this just tells you all the cuts were priced in. The market was at peak dovishness as far as it was concerned for this year for the Fed. And once the cuts actually started, the market started to go the other way. That attempt at a bit of a euro rally at the end of last week, that has now come undone. And what's interesting here is now that we're back under that interesting pivot level there at about 115.50, 115.40, it seems like we're in for the next run of dollar gains. Whether we are going to get these cuts seems besides the point, because the dollar seems to be gaining here mainly on risk aversion grounds as more and more capital goes to the safety of its unrivaled liquidity. And so it looks like we're on pace for probably another push higher, sub 115 perhaps next, around that low at 114.69, then maybe down sub 114 next.
All right, Ilya, really appreciate it. Have a great weekend. Thanks so much for joining us, Ilya Spivak from Tasty Trade. That does it for this edition of The Trade. Be sure to join us next time.